Trying to pick a HELOC over a HELOAN? Both can help you access your home equity, but in very different ways. In this video, I break down the pros and cons of each mortgage and show you which one is right for your financial goals. Hey, I'm Josh, and I'm a mortgage expert that helps homeowners tap into their equity and utilize it the smart way. Today, we're comparing two very powerful equity tools, a HELOC over a HELOAN. After this video, you'll be able to understand the differences and which one is going to fit your financial goals. So here's the problem. When you start your research for a home equity line of credit or a HELOAN, you're going to see a lot of these terms interchangeable on websites and bank websites. They don't do a good job at explaining the difference between both mortgages, even though both mortgages are drastically different. Picking the wrong one for your current financial goals could lead to paying more per month, higher interest, and just not be the best for your future. Most homeowners don't understand the structure of both of these programs or mortgages, and this is what we're going to break down today so you can make that smart decision. So let's break this down and start with a home equity line of credit or HELOC. Let's go through this again and see if maybe this is what's best for your situation. Like I mentioned in my previous video, it really determines on the amount of cash that you're needing and what you're going to utilize those funds for. If there's a lot of variable objectives you're looking to satisfy, similar to like restructuring debt or going on a vacation or repairing your house, or reinvesting those funds. If there's a lot of different things that you're looking to do, a HELOC may be the best option because it's going to give you that flexibility to utilize the funds for what you need and only when you need it. A home equity line of credit is exactly like it sounds. It's a line of credit or like a credit card against the equity of your house. And so if your house is worth a certain amount and you owe this amount down here, you have a certain percentage of equity that you can tap into for the home equity line of credit. Now, let's say you have a home equity line of credit of $100,000. This is like a credit card. You don't have to use that full $100,000. You can only use a smaller portion. So let's say you need $10,000 to pay off a credit card. You can do that. Or maybe you need another $10,000 to go on vacation and you owe $20,000. You can utilize that $20,000 and not have to pay a higher monthly payment based on the $100,000 like any other mortgage. These payments are only going to be interest-only payments as well. So they're going to be lower monthly payments based on the funds that you've actually used during a draw period that the HELOC has. And a draw period is going to be the amount of time that you can take that full $100,000. So generally between 2 and 5 years, and then adjust to a fixed rate mortgage for the remaining term. Make sure you communicate this because it can get a little confusing. So communicate this with your lender or broker like myself to really understand what that looks like in a draw period. But as you can see, a HELOC really gives you that flexibility to utilize the cash when you need it and only pay for what you use. Now for a home equity loan or HELOAN. A HELOAN is going to be a fixed lump sum loan. Now, this is not actually going to be a new mortgage similar to like a cash out refinance. This is still going to be a second mortgage like the HELOC. So it's not going to touch your first mortgage. You're going to have a lump sum loan or second mortgage on top of your first mortgage over here. So you're going to have two mortgages still, but the HELOAN is going to be separate. So you're going to have its own interest rate, principal and interest monthly payment, but you don't have to worry about paying like the property taxes, insurance, and all of that lumped into that mortgage like there is in the first mortgage. So if you open up a HELOAN for, let's say, $50,000, most of the time you're going to have a term between 15 and 30 years, depending on what you negotiate with your lender or what you're looking for. Now, the monthly payment is going to be based off of those terms. Now, the HELOAN will have a higher interest rate because it is a second mortgage. There's more risk being taken on by the lender. So your first mortgage is going to have a lower interest rate than your second mortgage or HELOAN. Your HELOAN is going to have that same structured payment where it's the same monthly payment month over month. It's not going to change similar to like a HELOC would. If you use $10,000, $20,000, $30,000, it's always going to adjust based on the amount that you use. A HELOAN is going to have the same fixed monthly payment based on the lump sum that you utilize. And a HELOAN is great for consolidating debt or using it for a specific reason. So if you have one objective you're looking to satisfy, a HELOAN is great because you're going to have that option to say, I need $50,000 to pay off a tax lien or to reinvest in real estate, something like that. You're going to be able to receive those funds, have a fixed monthly payment that you know is not going to change month over month, and you're going to be able to utilize that. Later down the road, what you will want to do though is actually refinance your first mortgage to combine both of these mortgages, but that's a conversation for another day. So in essence, a HELOC is kind of like a credit card based on the equity in your house, and a HELOAN is a separate mortgage or lump sum that you'll have a fixed monthly payment for. When I'm talking to clients, I always tell them it really depends on what you're going to utilize the funds for. Again, if you have multiple variables you're looking to satisfy, a HELOC may be a better option. Now, if you have one objective and you only need a certain amount of funds to satisfy that objective, a HELOAN may be a better option for you. Still have questions about these or want to compare both of them according to your situation? Comment your questions down below or book a time with me using the link in the description. If this video is helpful, please like and subscribe. And thank you so much for watching. I will catch you on the next one, guys.